Okay, so we got the worst Sunday night when the futures markets open, and fortunately, the worst didn't turn into catastrophe. So we held so far. We didn't really break out to the upside, so we're not out of the woods, but we didn't break down to the downside either. So I guess you could say it could have been worse, and it wasn't. So that's a good sign. That support is held. It's been a strong level of support. There's been multiple attempts here. I'm going to talk about now, are we, how likely we are to break it based on the technicals we're seeing, and what's the likelihood we go back towards the top end of this little range we've been in here as early as middle of this week. So I'm going to break all that down in today's video today based on how the market reacted over to the weekend news today. I'm also going to break down too what's driving this price action and a big reversal of a big move on Friday that could really dictate market posture going forward here. And then finally, our trade idea of the day today is a hedge, but in the long, with a long position rather than a short with the puts like we've been doing. So let's go ahead and get started. Today is Monday, August the 26th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast. You can see we had a little bit of an inside day today. Gapped up to the upside, gapped down on the futures at the open. By the time the U.S. stock market opened, we had filled in that overnight gap and then some, and to the point where we actually gapped up on this S&P cash index here. The range was very small after that, so only about 23 points, and very small inside day, inside of a big range on Friday, of course, inside of the lower half of Friday's range. So that's why, again, as I was mentioning today in the live Market Outlook live video, we're just not out of the woods yet. I mean, the nice thing is we didn't break. We haven't broke that support yet, and that's a significant level of support here. And the good news is we haven't broke that. The bad news is we're still in the retracement zone, right? This little 38 to 62% area between these blue lines, the 50% in the middle. That retracement zone, until we break out of it one way or the other, we've had a couple flirts with the upside. We haven't been able to get through, but we haven't broken through to the downside. So that's probably the best thing we can say about today's move, as small as it was that we held support so far. Of course, we still have the bearish trend pattern here, right? So we still have the dark pink shading, which means we have a strong bullish posture, strong bearish posture, and the red line. So those two things together can be bearish. Or that means we're on a bearish trend, and that's what we are, right? We're on the bearish trend. We just haven't broken through. That's why your intermediate line is not breaking down into the reversal zone. And even then, it doesn't usually stay down there for very long unless we're really into a big market sentiment decline. And it's also why you don't see the near-term line really breaking down either. We had a big sell-off on Friday, and the near-term line still above the lower reversal zone, setting up the possibility of a kind of a triple bottom near-term low at these levels. With this near-term line low being the first one out of the three that doesn't drop in the oversold territory. That's a good sign. Remember, when you're bullish trends, the near-term line should bottom above 20. When you're on bearish trends, it should bottom below 20. So, we're kind of bearish here, dark pink shading, red lines for most of this period. And yes, you're getting the near-term lines dropping below 20. But you're also getting the near-term peaks getting above 80. And so that's kind of really kept us, we got some volatility here to the upside and downside. There's really no trend. And if they were neither getting below 20 or above 80, if they were kind of peaking here in the middle and bottoming out in the middle, then we'd really be flat. There would be kind of real significant sideways action. We're just getting a lot of volatility now, and we would get very small moves, be a very tight range over this period of time. But the reality is we're peaking above 80. Those are bullish peaks. We're bottoming out below 20. Those are bearish lows. So we're not really getting yet a consecutive series of either bullish highs and bullish lows, or bearish lows followed by bearish highs. We continue to get both and that's why we're getting the choppiness, right? The significant choppiness that really, until we break out of either this low point or back above these highs, then we're going to continue just to be choppy and noisy from day to day, up and down, without a steady trend developing yet. So that's what the S&P looks like. The Russell 2000 or the Dow Jones Industrial. I mean, you can call that a Harami pattern. You've got lots of different reversal patterns. There's a Harami there too, a hammer pattern there, a morning star candlestick reversal, Harami. So there's lots of reversal candlestick patterns in this area, suggesting that we can turn this thing around. You look at the NASDAQ Composite, very same thing. Very, very significant Harami here. Big body on the one hand and a little tiny body right in the middle of the range on the other hand. Closer to, probably in this lower half, but really close to the middle. So pretty, it can be a reversal pattern. And so whether it turns into one or not remains to be seen. And we'll see, if this support holds. But as always, you expect support to hold until it doesn't. And you expect resistance to hold until it doesn't. And right now, support is still holding. And it hasn't broke yet. That relationship hasn't broken yet. So until it does, we expect support to hold until it doesn't. You are getting this, falling moving average that can act as a resistance as we continue to try to break above this 8,000 plus area, 8050. So keep that in mind. You've got pressure kind of pushing down on 7750. So until, the longer we go without getting above 8050, the more likely as we are that we're going to break that low point because of the pressure that's coming down. And you can see the same thing, the Russell 2000, not the same type of Harami, and you can see much lower in the range than what we saw with the Dow Jones. The near-term line forming a smidgen of a divergence. You can see a slightly lower lows here with obviously higher lows coming off of the cluster on the blue line there. So technically that would be a divergence pattern on the near-term line. And unlike the other indexes, the Russell 2000 has not been forming bullish lows on the near-term line. The highs, have not been getting above the 80th percentile. So it's been a lot more bearish. Its intermediate posture, it formed a cluster. Its intermediate line is already closer to being below 20 than the other indexes. So this has been a lot more bearish than what the other indexes have shown. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen or down below the video. That will notify you when these videos are posted. Click the thumbs up icon down below the video. That tells us two things. Number one, you got something out of the video today. Number two, you want us to do it again tomorrow. So it's a quick way for us to get feedback. It's our only way. If you like us doing these videos, let us know with one click. You can do that right now while you're watching. Comment down below as well on anything you got out of the video today. Love to hear what you're getting out of it. Join our daily Market Outlook email list. There's an email we send out every day to our subscribers with timestamp summaries of what we cover in these videos. Click on that link up there in the top right corner to subscribe to that list. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook community that we created on Facebook. Again, if you're watching this in our blog, a few points, a few things to note here on the page. We are doing a daily Market Outlook live video on the days that I do the Market Outlook, Monday, Wednesday, and Fridays. For now, at least, we're kind of getting this started. So there's the link for those that are subscribed to those plans. There's the link that will get you to that. Check that link every day, or the Monday, Wednesday, Fridays at 3:30. We go over all the trades that we made so far in previous Market Outlook videos. We manage them all the way to close, and then we put on today's trade before the market closes. So make sure you tune into that so you can be aware of what the trade idea is for the day before we get started. Also, we invite you to engage with us on social media. That's how you can make sure that Twitter and Facebook put our content at the top of your timelines. Not all the people who follow us see our stuff. So to make sure that you do, you want to engage with our content, like it, retweet it. So we try to make it really easy for you. Just click on, Come back over here. Click on this heart. That will open up this new window where you can like today's tweet. Very easy. Click on this image. It takes you to your Facebook account. You can like it from there, share it, retweet it. All those things. Comment on them. All those things will make sure that those platforms push you our content and put it at the top of your timelines. And we benefit from it as well, because the more engaging the content is, the more they will push it to everybody that follow us, and some people who don't follow us as well. All right, let's take a look at the charts here today, and you can see how today's candle is kind of fitting so far. This is a Heikin-Ashi candle, mind you. This is what the regular candlestick looks like. So really, really small range, of course, with today's range. But if you look at the Heikin-Ashi, it's fitting in the range there, and you notice that while we're not getting a transition quite yet, and all we have to do is to get above 28.99. Which we're only 20 points away, and we had a 31-point move today. So it's going to be very, very easy for us to get an upper and a lower shadow like we did last week again, and maybe with a smaller body. That would be more of the transition type candle. So we'll see if that ends up playing out. You notice that for the 1, 2, 3, so far 4th week in a row, we have not formed a lower low point on these shadows. See, when you're bearish, you typically form lower lows. When you're bullish, you form the higher highs. We have not been forming lower lows here. So again, another sign that we're not as bearish as we've been. We were more bearish in that week, and we've been kind of filling in the range. And we'll see if that support holds or not, and we bounce back up to the upside. You can kind of see an example of this back in early 2000 or late 2015, where you get the first bearish candle. This is probably the second bearish candle where you had the biggest move to the downside. Then you kind of fill around that range with never breaking below it before rising. And if you look at that candle in the regular, it was a long lower shadow, and those low points of those long lower shadows can act as support. And that's been the support that we've been holding this whole time. So until it breaks, we'll see how things play out. Again, that same kind of Harami pattern is developing here. See if that ends up holding or not. If that support holds, again, we expect that it will hold until it doesn't. And we'll see what kind of Heikin-Ashi candle we get. Of course, if we're going to get a lower low point on the candle, that means we're going to be breaking below that support. And if you look at the 3 green arrows, here, let's take a look at the 3 green arrow chart. For the S&P. We obviously don't have the 3 red arrows. We're close on the MACD. The MACD is not quite below its moving average, which is what gives you the red arrow in the histogram. It's still above its moving average. It's below 0, and so is the stochastics, and they're both falling. And we are still below the 8-day moving average. But again, last week we traded 3 out of the first 4 days above the 17-day. Before the Friday drop. So again, getting back above that 17-day will be the significant reversal, kind of a first step reversal. Getting above the 8 and then the 17 will be kind of your first couple of steps. And then, of course, after that, you need to get the 8 to cross above the 17. When the 8 crosses above the 17, like it did over here, then that's your next stage, right? You typically get the MACD crossing above its moving average pretty early, and we already had that. Now you kind of need to get above the 17-day and stay there, and get that blue line crossing, get the 8-day crossing up above the red line. So those are the stages of trend reversal there we still don't quite have yet. Now we'll take a look at the intraday chart today, and you can see the inside day we gapped up, filled in most of the gap early, and then closed at the high of the day. So that's a good sign. Obviously, it was a lower high and a higher low, so the inside day. And you can see that, this 287.50, that the area between 292.50 and 287.50, that's the area that we really break, that we either gap through, or we move up or down really quickly, to the point that there's still a vacuum there. There's still a hole of volume in that area. There's the support in this area. There's the resistance up there. And so breaking above 287.5 will be a positive development. I know we're at 288, but breaking above today's high, essentially, into this void, we'll go through that really quickly. Most likely go through that really quickly, as we've done in the past, simply because there's very little volume. There's very little buyers and sellers in that area. It goes really, really fast. until we get to 280, 92.50. And again, we expect resistance to hold until it doesn't. So, if we break above tomorrow or Wednesday, look for it to break right on through. Otherwise, any kind of pullbacks we get, look for support to be in this 285, 284 and a half in this area here, plus or minus a little bit. Breaking below it and breaking the new 4-week lows will be a significant downturn. And that was a concern last night. And unfortunately, we filled in that gap, that overnight gap, and came back. You can see the volume's kind of picking up here. So, if we gap down below these areas and we have a significant amount of volume, that's a gap that we would not expect to be filled. So keep your eyes on that overnight and any of these next few days for any downside gaps that we start off with, at the open that don't get filled, that we continue to go down throughout the rest of the morning, because that will be significantly bearish. That will be one of those runaway gaps that don't get filled in for a while. All right, let's take a look at the volume and the trading range today. Very small volume, very small range. Of course, we do have to include the gap. So we closed Friday at 284.85. Today's low 285.58. So probably about 3/4 of a point. So you can add, we're probably about 3 1/4 points. So well below the average. And then as you can see, the volume really dropped off about half of what we saw on Friday. So you put that 72 million shares into context here. Here we go. And you're down. That's below average, and the volume is just below the range, below average too. The ATR has not gotten up to uncomfortably high levels where we say, okay, we're surging, and neither is volatility. Volatility also has not surged up yet. And after its bump up on, on Friday and closing up here around 20, we continue to come down today. We're still in bearish territory, but we're on our way down. And again, more often than not, when volatility closes up, we typically follow that bullish close with a downward move. And we've already started with that today. I would expect that volatility to continue to come down tomorrow towards that 95 area as we fill in that void up towards 292.5, barring any negative tweets or news or risk events that may come out that can throw that off kilter, of course. All right, so let's take a quick time out here and just kind of review the technical outlook. So, the worst thing that could have happened, we avoided. So we gapped down last night. We filled in the gap really early. And fortunately, the resistance that I mentioned in last night's tweet didn't hold, and we broke through back to the upside. And we gapped up today, and we filled in some of the gap, but we didn't we didn't go beyond and break support. So support held as you always expect it to until it doesn't. And now we're moving there. We're back up to this 287.5 level. Above this area is that void all the way up to 292.5. Very good chance. The patterns in the recent past has been to fill that in and fill it in very quickly. Of course, depending upon what catalyst there might be for that. And we still do have to get through this 287. It's a kind of a minor resistance level. Without a catalyst, we kind of stay in. We probably trade tomorrow through the today's range and into Friday's lower end of its range as well. Kind of pitter patter around here until we get the catalyst to fill up that higher void, or whatever catalyst could break you through that significant support. And if that's the case, we're looking at now a market sentiment pullback. But that's not the expectation. The expectation is volatility will most likely continue to come down since it never did surge. We expect that will most likely continue to come down here. And it's eventually, whether it's tomorrow, Wednesday, or Thursday, some catalyst will provide the buyers the juice to get you through that 287.5, get you back up to 292.5, where it's going to need a lot more juice to break through that and then start this intermediate run. And that we've been kind of building up the potential energy for during this pullback. So what do you think? Do you agree with that assessment? Disagree? Let me know there. Click on that link right there. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below what you're seeing that would suggest otherwise than what we just came up with. Of course, there's a million indicators and different charts out there, and if you see something that suggests something different than what we come up with, please share that in the YouTube comments down below with the rest of our Market Scholars community. All right, now let's take a look at what's driving the price action today. Of course, it was the kind of a reversal of Friday. Friday, especially after the close, after the futures close, we had some really negative tweets from Trump about raising tariffs and starting tariffs sooner rather than later. And it kind of sent the safety trade that was already going because of China's tariffs and Trump's retaliation in the afternoon, kind of sent the safety trade higher. And you can see it's been a really popular trade. So that's why it's kind of like, this isn't usually how recessions start. They usually don't start with the safety trade already so overbought. The safety trade usually isn't up 18%, 14 to 18% in a 3-month period, mind you. This is a 3-month chart. I believe it's a 3-month chart. Yeah, 3-month chart. They're usually not up that amount in 3 months before, when we're only a few percentage points off of all-time highs, and before we've really fallen off the cliff or broken through either old intermediate lows or even worse, old market sentiment lows. So the fact that they're already up so high makes you think we might have priced in something more than it needs to be. And you can see where the lows are here in the S&P, and you can see they're still outpacing these international stocks. Emerging markets have really come down during this decline, and crude oil, commodities in general, both agricultural and crude oil, both down 7-8%. During this 3-month period. If I just look at just today alone, so let's go here to August and just look at today for the 10-minute chart. You can see that small cap stocks, U.S. stocks in general, were the best performers. Developed markets have been a good performer. We talked about that in portfolio management on Thursday, and how we might, in fact, that was the main idea of that particular class, was positioning ourselves between developed and emerging markets. We made some adjustments there. And you can also see the dollar was strong today. So that's a big, with gold and long-term bonds down. And let's take a look at the dollar chart. You can see just, it had such a big down day on Friday. That's a nice little reversal today. You can see on Friday you had, a yellow line with light pink shading. That's usually and when you've previously had dark green shading with the red line, that can be a bounce signal, and in this case that's what it was. It ended up being a bounce signal. Now we're not back to the dark green shading yet because the intermediate line hasn't turned back up, but we still have the green line because we're back above the rising moving average. So you see how it can, when you get the light pink shading and the yellow line, how that can be a reversal sign. It was here previously for the dollar back in August 9th. And could be the case again 2 weeks later here on August the 23rd, and so far that's been the case. The dollar breaking or trying to get back above this 98 level and holding it this time. All the other attempts have failed to hold, and gloriously failed here on Friday. But in one swoop, instead of multiple days trying to get back up above, it got right back up above in one day. So interesting to see this development on the dollar take hold. From a long-term standpoint, you can see that we've got lots of transition candles here at this resistance. So until it breaks out one way or the other, but you can see how it's this kind of, you've got resistance up here, you got support down here. It's almost like my little, I just went to a soccer game and my little 7-year-olds playing, and when you're watching little 7-year-olds, sometimes you get teams where they're always on one side of the field and they're hardly ever on the other side of the field. So that happened to be my kids' team. Like, they're all my kid's goalie was really, really busy and played his team's goalie. He got a lot of action, whereas the other team's goalie was kind of sitting around doing nothing. And so whenever one team's goalie is a lot, is busier than the other, eventually that, they're going to get a breakthrough. And that's kind of the expectation here with the dollar. It's really batting, it's not going up and down from resistance to support. It's hanging around this, it's staying on, if that's midfield, this 50% line, it's staying on that side of midfield the entire game. So at some point in time, I would expect that we'll break on through and work our way higher, and that's going to have its implications. It won't necessarily be bearish for stocks. It will, U.S. stocks, it will be bearish for international stocks from a relative strength standpoint. We would expect that to be the case. Treasury yields continue to be significantly bearish, but you notice how we're not getting new lower lows there either. So if you look at the Ichimoku cloud, we've been so bearish, well below the trend line, of course, way up above the red line here. This is the close currently. So we've got a long ways to go to change the trend, right? Even if we kind of hung around here for a while, we've got to get all the way, we've still got a week or two before things really kind of change around. And the trend, this is the weekly trend strength indicators, are so bearish. But you notice that a couple of days ago, before this Friday drop, we had closed above the green line. That's not like the reversal with the most confirmation, but it is a reversal. And the fact that we're getting it's a positive sign. Now, of course, getting back above the blue line will be more significant, and even that's not 100%. Of course, getting through the cloud will be the most significant. So you can kind of see, looks like that we've set kind of a low point here with some long lower shadows on the weekly chart. You can see the long lower shadow there, the big candle, and then the inside week that we had last week, and so far having an inside week. So we can see where support is, and we look for, say, okay, let's see if we can't get above that green line here, especially on the weekly chart, and get that reversal that will send us, it will set the low point and send us through. We might, in fact, we got a little bit of a fake out right there inside the cloud, so it's not 100%, but it's definitely, that's the kind of initial sign that we'll get some kind of reversal. And keep in mind, again, the yields for the 10-year are so high in the U.S. compared to Germany. So the pressure for yields is to continue to come down until you see those European yields move up, and that's going to be really bullish for the dollar. If yields do continue lower, I don't think they'll continue lower at this pace, but if they do continue lower to come down to where the European yields are, that will be in the past, in the late 90s has been the last time we've seen this type of environment that was very bullish for the dollar in the late 90s. It was very bullish for U.S. stock markets as well, and we'll see if that ends up being the case again. All right, if we take a look at the foreign markets, there's a lot of pink shading here, a lot of pink shading. All of these pink shadings means that we're below 50 and we're falling on the intermediate line on most of these. The intermediate line is rising on Russia, and it's but it's falling on South Korea. So below 50 on most of these, except for the U.S. You can see it's up to 35. I believe that's the highest one that we've got. Yeah, that's the highest intermediate line value that we have among all of these. Of course, the China, which is the other counterpart in these trade issues, is still below 25. And all of these, you can see. Look at Brazil getting you a cluster, UK getting you a cluster. Lots of clusters on India here lately. Germany a week ago cluster. Japan down only 3%. Italy down 2.5%. Everything's down over this 6-month period, except for the U.S. stock market, which is up 3% in the 6 months. So it kind of gives you an idea. There's China down 13%. South Korea, which is having its own issues with trade issues with Japan, down 19%. Brazil down 12%. So big losses, 9%, 5% over 6 months. Big significant losses, but lots of oversold clusters. So again, as the market kind of, set its low point here with all these clusters, even though the S&P is not getting one, a lot of these foreign markets that have led the declines have been. And we'll see if they continue to, if they turn us, and if this low point is set and we turn back around. If you take a look at long-term views here, we'll just look at these weekly charts. Look at, one thing that's a little concerning is these red lines are now rolling over. go back. This one doesn't have the 3-year. Oh, there it's already on it. Let's go 3-year weekly here. 3-year weekly on this one. I mean, look at all the look at all the red lines. There's a yellow line in Canada, so that one's not as bad. And it's only got its intermediate line's falling at 69, so that means it's light green shading on its chart. So that's actually kind of a buy signal there. And then you look at the S&P. Let's go to 3-year weekly on this one, and then 3-year weekly here, and 3-year weekly here, and on this one. I think we got them all now. So you can see light green shading, light green shade. What's above 50? Light green shading, yellow line. That's a buy signal. That's a buy signal. That one is below 50 now, so we actually have dark pink shading with the yellow line. Then you have red line there, 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 red line there on the UK, red line on Brazil. So, and then of course on China. So that's a little bit of a concern. The fact that you can see when they get these red lines on the weekly charts previously, late last year, you know, that we ended up being bearish here for a while. Hopefully, even in the US, again, we have light green shading because it's at 70 on the weekly chart. It's the highest one again out of all of these. And the yellow line, you know, that's again a buy signal like we talked about on Friday. So we'll see if what we're seeing on Canada and Russia and the US ends up being the buy signal that's needed to lead higher. And that's why, again, outside of Russia, a lot of these emerging markets, China, India especially, Brazil, they're all struggling. South Korea, they're all struggling. So emerging markets, you know, appear to be getting hit pretty hard, and would be hit really hard if the dollar continues to push to an upside. I didn't show you this on Friday, but the weekly charts here, remember the S&P, let me bring up the weekly chart on the sectors. But you can see, I mean, again, you see this bullish pattern here, light pink shading and the yellow line. But you also see here that you've got really strong trends on real estate, really strong trends in utilities and staples. That's why they're up here, way up above rising green lines. Again, another sign of just how bullish the safety trade is. Again, not the typical sign you see when we're just a few percentage points off all-time highs. I mean, you might see some beginning rotation into these areas, but you don't see such stark outperformance. 16%. Well, this is a 3-year period, so you know, 25, 10%. I mean, there's pretty strong numbers. Whereas on the other end of the spectrum, technology is also looking very strong. Light pink shading. We don't have the yellow line yet. Healthcare has the red line. We'll see what the Johnson & Johnson news, if it has any impact in the overall sector. It's kind of a one little segment there. You can see discretionary also kind of pulling back, very similar to the S&P 500. Industrials is below the moving average, but this line's still yellow. Same thing with financial, same thing with materials. So there's opportunities, especially in some of these kind of areas that have been so cyclically downturned here. Energy still is the one area to avoid, even though it's getting a cluster again at the same level where I got a cluster last time. It bounced off of this level at the end of 2018, right at the same spot. So, I mean, the stock market's well up above its 2018 lows. Energy sector is right at its 2018 lows. Everything else is well off of those low points, except for maybe healthcare isn't as high. But a lot of these way, way high off of these lows. Energy is just struggling. I did update the sector correlations from Friday. So if you go to the blog post here on the market forecast and click on it, should probably still be up there, depending upon how many people are looking at it. And again, the Market Scholars commentary section, so this section in our blog, the market commentary section, that section is a part of the price. You know, when you look at our pricing charts, that is part of the basic plan. So you do, you know, well, here's our premium, and this is where most of our subscribers are. And of course, most of them are paying the yearly price to get the $83 instead of $300. We have some people that are doing the monthly, and they get the free trial for that. But the basic is the free version, and you do have to have at least that to see our market commentary blog posts. And again, you just log in, and usually if you click on the link to it and you're not logged in, it'll ask you to. It'll ask you to log in or subscribe. And if you already have subscribed, just log in, and you'll take you right to that page. But here's the current correlations, and you can see that utilities and real estate are just not correlated at all with the rest of the markets. They've maintained strong bullishness where the markets have not, again, overbought safety trade. The reality is the correlations, as I mentioned here, the correlations have actually come down. From August the 9th, the average correlation was 62.7%. We're now coming down to 58.2. So, keep that in mind that over 2 weeks, if you look over that same period, over 2 weeks, we'll go to sector comparison, and then we'll take a look at the time frame of August the 9th. And let's just go to the open on Monday, the 12th, until the end of the 23rd. So we'll actually go to the end of the 23rd, and we'll go like 20 minutes. So there's the performance over that time frame. Utilities, real estate, staples to a degree. Staples is also, you can see staples have also been the one sector that, here's staples right here. You can see it's got more orange than any of the other. Lots of red, which is very strong correlations. Orange is moderate. Green is weak. And then white is just, there's no correlation or is negative. So the one sector with hardly any red or orange is energy and utilities and real estate. Of course, we know what's going on the opposite ends of the spectrum. Staples has the most orange, and you can see what's going on there. So they're all up when the market's down 2.39% over that 2-week period. Energy materials have lagged behind the most. So we've been focusing a lot of our trade ideas lately on hedges in case we break through these low points. Well, here's a hedge that you can actually do a bullish trade on. If we take a look at the market forecast indicator and pull up Newmont Gold Corp, formerly Newmont Mining, you can see how it's got a nice little bullish trend going, and it's kind of a sideways action. You got dark green shading because the intermediate line's turning up above 50. You're actually going to have a green line here because we went from 38.45 yesterday to 38.46. So we're above what is now rising moving average. So technically that should be green. It will be green tomorrow. And the intermediate line is rising up above. We don't have the near-term line above 80 yet. That would be a nice confirmation, and that's why we're not going to be too directional with this trade. But we're kind of getting an ascending triangle forming here with equal highs and higher lows, an opportunity to break out, at least stay up above this resistance or support that we formed here and form another higher low point. And if you take a look at its 3 green arrow chart, here we go, Newmont, you can see that it has 3 green arrows. We're above a rising moving average. It's green, right? It'll be green tomorrow. The MACD is green. The stochastics is green. They're both rising. If you take a look at the 2-line versions of this, you can see that they're both rising above their midpoints of their chart. In fact, the 8 and the 17-day, we had diverged to the downside. We've been converging back up towards the 30-day, and now we've broken through with this little move that we've had today. And now the 8 and 17-day look like they might be crossing up above. So good sign there. You look at the Bollinger Bands for Newmont, and you can see that we're well above the value area, and we held support at that volume node. We can fall through really quickly if we broke it, but as of now, we held support there, and there's very little resistance to the upside for any upside moves. So it could be a quick trade. And then you look at its DMI, and again, another reason why we're not like buying a call option here is because we don't quite have that bullish line getting above 25. Ideally, get above 30 if we really want to be directional. But at least getting above 25. So we're not quite there yet. You do have the orange line dropping below 20, so that's just positive. You just need the blue line to get above 25 as well. Finally, looking at the long-term view for Newmont, and you can see it's in a golden cross environment. We had consolidated to the 50-day moving average, and now appear at least to be attempting to bust out and continue to trend to the upside. So we can take a look at doing a trade. Like I said, we already did this in the live market outlook session, but we can look at selling the 38.50. It's got a 36 delta, buying the 36.5. We set our stop limit order at 50 cents. So stop limit at 50 cents to GTC. Obviously, you can see it hasn't filled in yet, so the orders are still there. But that will require, depending upon where the market opens tomorrow, once the mid hits 50 cents or lower, then it will set in a limit order at 50 cents to try to fill in at that price. And again, depending upon where we open, we'll see if we end up getting filled into that spot. And we'll update that on Wednesday in the live market outlook and see what it did, and as well as look at the new trade for Wednesday. And that does us for today. So again, you've heard from me now. Now I want to hear from you. Let's keep this conversation going in our Market Scholars forums, specifically in our Market Outlook forums. So any questions or comments you have for me, use that link up there. It takes you to our forums. You can open up any new thread with any question or comment. If you have any replies or comments on anybody else's threads, make sure you reply to them as well, so we can keep this back and forth going there. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between these videos from day to day, and then join our community that we've created at marketscholars.com, as well as on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.